Hello, everyone. So we are looking at topic 7 about revenue recognition. So for this particular topic, our learning objectives will be all of these. So we will be looking at IFRS and ASPE on how to recognize revenue under both of those methods and few other different special circumstances. So the revenue basics. So revenue, what we know so far about this element is that we recognize the revenue when the revenue is earned. But accounting for when the revenue should be recognized, it's complex. And much of that complexity is because of the structure of the sales transactions. So the decision when to recognize the revenue or transaction and how to measure and present it are the keys. So, what we are looking at here is what is given up and what is received. So, the basics of your sales transaction is what's given up. So, when you're giving up something, it could be, or the deliverables as we call them, could be your sales of goods, which are the tangible assets where the control is transferred at a point in time. On the other side, you could look at sales of services, which are non tangible. So there is no legal title that transfer, and these can span over a period of time. Then you could have your contracts or agreements where you have sales of goods as well as services as a combination. So the complexity in that sense is to measure each component of your bundle sales or multiple deliverables and knowing when to recognize the revenue. So the economics of your sales transactions, what is received, in most cases, when we sell something, the consideration in exchange is your cash or cash like, which is monetary transactions. Often you would see something that is non-monetary, that is in exchange for the services or goods provided, you would see another goods or services, which is also known as barter transaction. So these terms are usually specified in the sales agreement, which is your amount, nature, timing of considerations, and right acquired. Now, when we look at in the general sense, your values of deliverables sold is exactly equal to the value of your considerations that is received. Now, often we would see some special deals. Is the sales happening in normal course of business? Is this a normal sales or are there special sales? So these special sales are referred to as concessionary terms. So concessionary terms are negotiated by both the parties in the contract, and that has some favorable terms than normal. Some of the examples of these concessionary terms are discussed on this slide. For example, in the normal course of business, the selling price reflects a normal profit margin for the company for that product. Under the concessionary term, you're looking at selling prices that are deeply discounted. When it comes to the payment term, under the normal selling terms, we are expecting the payment between net 30 to 60 days as but under the concessionary or the special terms you are looking at longer term payments such as your 90 days or even installment payments. The extension of credit under the normal business terms, we only do business with customers who are creditworthy, but under the concessionary term you could see the riskier customers that you're transacting with your shipping terms. Under the normal sales, the product is ordered and ready to ship, but on the concessionary terms, it is shipped at a later date. For example, the entity may hold the inventory in its warehouse for an extended period of time. So these are some of the common examples of concessionary terms. Now, what are the legalities of your sales transactions? All of this actually falls under your contract law, which is most relevant for the sales transaction. So your contract law or your sales transaction represents a seller and a buyer and the agreement that they have come to. So what are the sales and services that both the parties have agreed to provide or to receive? What are the terms with regards to FOB shipping point, FOB destination? Who takes possession of goods where and when? Okay, so all of that is or does fall under your contract laws. Now, with regards to revenue recognition, there is a different approach that's taken by ASPE as well as your IFRS. So, most of the focus for us will be on IFRS 15. Under ASPE, we recognize and measure revenue based on whether it has been earned. And this is something that we have focused on up until this point in time. So, here we are looking at change in control from the seller to the customer. But under the IFRS 15 approach, this approach is way more detailed. So every contract goes through this 5 step process. So under the 5 step process, then, the first step is to identify whether there is a contract that exists with the customer. The second step is to identify how many performance obligations are in that particular contract. Then, thirdly, we determine the transaction price. Fourth step is to marry step 2 and 3. So then we take the transaction price, the total transaction price in step 3, and allocate it to different separate performance obligations that were identified in step 2. That calculation makes up step 4. And finally, step 5 is when to recognize that revenue. So, with regards to identifying your contract is an agreement that creates enforceable rights and obligations. When you are looking at identifying separate performance obligation, so your performance obligation is a promise in the contract to provide a product or the service to the customer. And the only way this will be a distinct performance obligation is if the customer can benefit from the goods or services on its own or together with other readily available resources. Your transaction price is generally stated in your contract. So, whatever is your contract price or the total consideration is your transaction price. Your step 4 is to allocate the total transaction price between different performance obligation, and that usually is done based on the relative fair values of your each consideration that's being given up. And the final step under IFRS 15 is to recognize revenue either at a point in time or over a period of time, depending on when that revenue was earned or the performance obligations were satisfied. Under the ASPE Section 3400 earnings approach, your revenue for the sales of goods are recognized when all of these following criteria are met. So the risk and rewards of your ownership are transferred to the buyer. The seller has no continuing involvement nor effective control over the sold goods. Cost and revenue can be reliably measured and collectibility is probable. If all of these criteria are satisfied, then under ASPE, we will go ahead and recognize revenue. Looking at IFRS 15 revenue from contracts with customers in detail here. So once again, we are discussing our 5-step process here. So step 1 is to identify the contract with the customer. Now, a contract is an agreement between two parties. This agreement can be written, verbal, or implied. Okay. For example, when you buy something from, let's say, Walmart, as soon as you pay for the goods and the receipt comes out, if you flip the receipt at the back of it, it talks about the um, return policy terms and conditions. That is a contract between two parties. So contract can be written, it can be verbal, it can be oral, it can be implied. In this case, what we are talking about is implied. Nobody told you, but that is a contract. So upon entering into a contract with the customer, the company obtains the right to receive consideration from the customer and assumes obligations to transfer goods or services to the customer. So, the first step in our accounting process or under IFRS 15 is to determine if there is an existence of the contract, which once again could be verbal, oral, or implied. Step two is to identify our performance obligations. Now, these performance obligations, these can be different types of products or services or a combination of products and services. But what determines a separate performance obligation is whether the customer can benefit from those individually or along with the other resources that they have available. So here the promises may be explicit, implicit, or possibly based on customary business practices. The product or services must be distinct where the customer can benefit from it. Only if that is satisfied, you would look at the performance obligation being distinct. Otherwise, they would not be viewed as distinct performance obligation. So, a performance obligation in a multi obligation contract is distinct with the contract, then it should be accounted for separately. And it's really critical that we are very careful with identifying how many performance obligations exist, because depending on what we determine on step two, after that, in step three and four, your allocation of revenue to these performance obligation would change based on what you determined on step two. So it's rather critical to know how many distinct performance obligations exist under that particular contract. These are some of the examples of identifying the performance obligation. So the first one is the sales includes an option to acquire a future goods or services such as your loyalty points or coupons for free or reduced price. So in this case, the company will set up two performance obligation, one for the current sale and other for the future sales. In the second example, we have upfront fees are received from a product is before a product is delivered or the service is performed, such as your membership fees, activation fees, or your gift cards. In that case, under IFRS 15, the whole thing will be treated as a single performance obligation. Number three, some long term contracts provide a series of goods or services that are substantially the same over the life of the contract. Under IFRS 15, this will once again be treated as a single performance obligation. And finally, a company that sells a product with a warranty for 120 days and also sells a separate extended warranty for additional 3 years. Now, in this particular case, the business will set up two performance obligations. One is for the product and the 120 days warranty that would be considered as the single performance obligation because they are interdependent. You cannot separate the 120-day warranty from the product. So they have that dependency, and the customer cannot use one or the other without having both. Okay, so that is a single performance obligation. On the other end, the 3 year warranty will be seen as a separate performance obligation because it's not interdependent on the product. The step three is to determine the transaction price. Now, transaction price is the amount of consideration that a company expects to receive from the customer in exchange for the goods or services. Generally speaking, the transaction price is stated in your contract, but the complicating factors with regards to your transaction price are variable consideration, time value of money, non cash considerations, and consideration paid or receivable to the customer. So, we will be looking at each one of those now. So your variable consideration is sometimes your transaction price can be dependent on a future transaction. For example, receiving a bonus in future, but that is only, for example, receiving a bonus if the Calgary Ring Road is completed in a certain time frame. Okay, that is a variable consideration. That's an example of a variable consideration. So the companies in that case have to estimate the amount of consideration to determine the amount of revenue to be recorded. But they have to make sure that they have experience with similar contracts and can estimate the cumulative amount of revenue, and it is highly probable there will not be any significant reversals of revenue previously recognized. Okay, so what they're saying here is if the ring road construction is on schedule, then it's likely that the bonus will be received. So then the company has to look at their past experience with regards to similar contracts and make sure that there are no uh, probabilities that there will be any significant reversal, which means that most likely they will get the bonus. If that is the case, then they will have to recognize or estimate the amount for that particular variable consideration. Now, how to do that is through an expected value method where you're looking at the probability weightage amount in the range of possibilities consideration. Or alternatively, we can look at most likely amount, which is a single most likely amount in the range of possibilities. So out of, let's say, 5 different possibilities, we are just looking at the single option that is highly probable. Some of the examples under your variable consideration here. So a sales contract that allows the customer a right of return. In that case, your seller has to recognize the revenue from the sale of the product, considering there are future returns. So for those future returns, they will have to set up a refund liability as well as an asset for its right of recovery of inventory. So if the customer returns something for the seller, it goes back into the inventory. So they will set up two different things. One is the revenue from the sale of the product, but at the same time, they would recognize liability and an asset for the recovery in future or the returns. Now, some customer may be given a volume discount when buying large amounts. If it is likely that the buyer will receive the rebate, then the potential volume discounts should be recognized by the seller. Time value of money. Now, in most cases, the companies receive or are paid for their consideration within 1 year's time, which is also called as short-term financing. So in that case, if your money is received within a year's time, then we don't have to do anything with that because the value of that money is not considered to be lost. But if the consideration is over 1 year's time or over a multiple year horizon, then we will have to calculate time value of the money or the present value of your transaction price. Okay, so let's say, for example, if your transaction price is $300,000 that is stated in the contract, but the payment will be received, a short payment is received in the first year, then the payment comes in second year, and then a third year. So the 300,000 will be received in 3 years. So your time value of money will have to be calculated because this will then be viewed as a financing agreement. So we will use the discounted rate, which is tied to the customer's credit risk. We will report the effects as either the interest expense or interest revenue. And under ASP, there is no such requirement, but we will use the fair value to measure the transaction. Sometimes you might end up seeing non-cash transactions, which are also called as barter transactions. So when the companies receive consideration in forms or goods or services, or any other non-cash consideration, they will recognize revenue based on the fair value of what is received, not what's given up. So if the customers contributes goods or services to fulfill a contract, it should be treated as a non-cash consideration and include in the transaction price as long as contract has passed to the company. So whenever you're looking at barter or non-cash transactions, you always want to consider the fair value of the asset that was received, not the asset that was given up. Looking at step 4 in detail, we are allocating the transaction price of performance obligation here. So our transaction price is what we determine in step 2. And that transaction price is based on what was the contract price, the time value of money considerations, and other ideas that we looked at in the earlier slides. Okay, your variable considerations, for example. Once you have determined your transaction price, then sorry, the transaction price was step 3, not step 2. So the total transaction price, give me 1 second there. Okay, so with your transaction price, then we are looking at your, in step 4, we are looking to allocate your transaction price to separate performance obligations. Sorry, the step 2 is the performance obligation and step 3 is the transaction price. My apologies for confusing you. Okay, so with step 4, we are looking at allocating the total transaction price to the different performance obligation that we established in step 2. Now, how do we do that? That can be based, we will be using an approach called as proration. Okay, you guys have already looked at your proration when we had discussed the basket acquisition in the earlier accounting courses, but that is what we will use in step 4 in order to allocate our transaction price to performance obligations. Now, a company satisfies its performance obligations under step 5. Now, step 5 talks about when to recognize revenue. Either we can recognize a revenue at a point in time, or we can recognize revenue over a period of time. That really depends on how and when your performance obligations are satisfied. So some of the indications of transferring the control is the company has the right to payment, the transfer of the legal title to the customer, the customer has the physical possession of the asset, and your provider or your seller has the customer has the significant risk and rewards, and the customer has accepted the asset. If all of these transactions are satisfied, then we see or deem this to be the control. The control has passed to the customer, which means the seller can now go ahead and recognize the revenue. Recognizing revenue over a period of time, this really ties to the fact as when your performance obligations are satisfied. So let's say if you're looking at a product, if you're selling a product, then as soon as you transfer the product to the seller, then the performance obligation is satisfied. But if it's a service that we are performing, then we will have to wait up until the service is completed. Now, these things can happen over a point in time, or they can happen over a period of time. Let's say there is a agreement that you will provide services or support, technical support for next 3 years. Then in that case, your revenue with regards to the support item will have to be recognized over the 3 years time horizon. So it all ties back to when your control is passed or when your performance obligation is completed. Special cases or specific cases that we are talking about with regards to your revenue recognition, such as your repurchase agreement, bill and hold, principal agent relationship, consignments, and warranties. And we will be looking at each one of this in detail. So your repurchase agreements are very unique. This is where the seller is selling something to the buyer, but at the same time, the seller has the obligation to repurchase that asset back from the buyer. Okay, so it does a whole circle. So the problem in this transaction is that did the company actually sell the asset? Because the company sold the asset and it came back to the company. So it's a full circle. So in accounting terms, then we view this as a financing transaction or a borrowing transaction, which also uses a contract liability account. Now, this is a very specific agreement. We use that at our work, but it's not a very common. Repurchase agreements are not very common out in the industry. So at this point in time, I expect you to recognize what this is and realize what repurchase agreements are, but we will not be doing any accounting examples on this as to how to account for this transaction, given the niche of that subject and that these are rare instances. But on a theoretical level, you are expected to know what a repurchased agreement is. Bill and hold agreements, on the other hand, are fairly popular and widely used in the industry. This is where the buyer and the seller are in a agreement. Now, the buyer for some reason request the seller that they are not ready to take possession of the asset or the transaction or the item, whatever was in the question. Okay. Now we have done bill and hold where we had placed order for an asset, for a machinery. We were not, the machinery was ready. The seller had the machinery ready for delivery. But we as buyers did not have other legwork completed, so we were not able to take possession of that asset because we still had other items to look at. We were setting up a whole manufacturing facility, so it did not make sense for us to take possession of the asset up until our groundwork for setting up that machinery was done. Okay, so in that case, us as buyers requested the sellers to hold the asset for us. That is what a bill and hold agreement is. Now, bill and hold agreements are very unique. In this case, the buyer is not yet ready to take the delivery, but they do take the title and they accept the billing that comes with it. So the buyer has the risk and rewards to that, but the seller does have the ability to recognize the revenue, but only if the four criteria that are mentioned on the screen are satisfied, which is the reason to hold the inventory is substantive. The product must be identified separately and belongs to the customer. The product must be ready to ship. And the company, which is the seller, cannot use the product nor sell it to any other customer, which means the product is custom made. It's not easily substitutable. If the product is substitutable, then it does not fall into bill and hold agreement. So the seller can recognize the revenue only if all of those four criteria are met, which will establish transfer of control. Your principal and agent relationship, the best example of your principal and agent relationship is the real estate. So for somebody who is looking to buy a house or sell a house, they are the principal, and the agent is just facilitating that transaction. They are finding a buyer. Let's say if you're looking to buy a house, you are the principal, and the agent, the real estate agent, is just facilitating that transaction. They're helping you look for that property that matches your needs. So the agent does not take any financial risk or doesn't have any financial rewards, or if they do have some, then they are limited to the contract. Okay, so the indicators that a company is an agent is that the other party, which is the principal, is primarily responsible for fulfilling the contract. The company does not take risk associated with the inventory. So your agent is not responsible should something happen to the house, okay, or if you change your mind. So they do not have any risk involved to the inventory. The company does not have ability to set the price, So the agents do have some limited ability to suggest what you should be um, targeting for when you put an offer for the house. They can sway some of your decision, but they don't have complete ability or unanimous ability to do that. So they don't have the ability to set prices. The agent would always receive commission, and the company does not have customers credit risk for the amounts receivable. So should something go wrong, agent is barely on the hook for anything. So that is your principal agent relationship. So in this case, we need to determine who is principal, who is agent. Then we will look at how to do accounting for that party. Then we are looking at our consignment and consignment relationship. So your consignment is where you have a consignor and the consignee. Consignor is the party that is the manufacturer or the party that holds legal title to the goods. But the goods are physically held by the consignee. So the consignee gets some sort of commission by facilitating sales for those consigned goods. But the legal title, the risk and rewards then belong to the consignor. So for simplicity's sake, you can look at the consignor as the principal and consignee as the agent. Once you determine who you are in this relationship, whether consignor or the consignee, then we will look at how to do accounting for those. And then comes our warranties. So with regards to our warranties, there are two types of warranties that can be provided. There is an assurance types of warranty and the service type. The assurance type is where the product comes with the warranty, such as your standard 1 year warranty that comes with your laptop computer. Here, your product and the assurance type warranty is one performance obligation. It's not tied to anything. Okay, they are interdependent. You have to have the product in order to have that 1 year inbuilt warranty, and the cost of that is already inbuilt in the cost of the laptop or computer in this case. So it is seen as a single performance obligation. But the service type warranty is where the company sells a separate product, such as your extended 3 year warranty on laptop for an additional charge. In that case, you would end up seeing two different performance obligations. One is the laptop with the 1 year warranty, and second is the 3 year additional warranty at additional cost if you did purchase that. So that would be the second performance obligation. So that is all, my friends, I have with regards to IFRS 15 and revenue recognition. We will be talking about your long term contracts in the second half of this recording. Thank you for listening.